Hello and welcome. This is Professor Svark, and today we're going to walk through selected topics in Chapter 8. I want to remind you that these sessions are selected material only, so you are responsible for reading all the chapter, taking notes, and learning it. Seek help if you have any questions about this chapter, and make sure that you're completing all the coursework and, in addition to that, self-quizzing in this chapter. Chapter 8 is a fairly large chapter, so it may feel like a difficult chapter, though each piece of it is not very difficult. It's just that there's a lot of application. Chapter 8 is all about long-term assets, which include fixed assets. Remember, we learned about those in Chapter 3, buying the long-term assets and then depreciating those over time. So we're going to talk about that today, the purchase, the depreciation, and we're going to learn 3 different methods to depreciate it. Then we're going to talk about the sale, and we'll finally talk about amortization of intangibles and depletion of natural resources. Okay, just to refresh your memory on depreciation, remember that in accounting, that's a special term to basically say that we are systematically allocating the cost of the asset over the life. So it's not necessarily equaling the decline in value. For example, when we talk about a brand new car drives off the lot and declines in value. We're talking about accounting, a systematic process of allocating the cost of an asset to the years that we're going to use it. Okay, so whenever we're talking about fixed assets, sometimes they're called plant assets, sometimes property, plant, and equipment. They have to be tangible in nature. Okay, so you have to look at it, see it, touch it. They have to be used in operations. Okay, so if they're not used in operations, for example, if we have a piece of land that we're holding for future to build a property on, that would not be considered a long-term fixed asset. That would be considered an investment. So fixed assets are assets that we're currently using. They're expected to benefit future periods, so not just this period, but future periods. And again, they're called property, plant, and equipment. So today we're talking all about the life of these assets, including the purchase, the depreciation, and the disposal. When we talk about purchase price of any asset, I think I talked about this in Chapter 4, an easy way to remember it is it's the purchase price and all the costs it takes to get it to you and ready for use. For example, it could include taxes, transportation in, insurance, while in transit, not while being used, but in transit, and installing, assembling, and testing, getting it ready for use. So again, easy way to remember this is everything it takes to purchase an asset, get it to you, and get it ready to use. The first journal entry we're going to look at is a lump sum asset purchase. So oftentimes companies purchase not just one asset, but multiple assets at one time. This is very common for property. When you and I might go out and buy a house, it's sitting on land, and we don't necessarily think about the cost of the land versus the cost of the building. But companies are extremely concerned about this because companies do not depreciate land. They depreciate all the other fixed assets, but not land. So it's very important to separate out these costs. It would also be important, for example, if you had some land improvements such as fences. A fence is not necessarily going to have the same amount of years, useful years, as a building. So we'd want to separate these types of assets out so that we could depreciate these assets appropriately. So in this example, we're only talking about 2 assets, and this is from your printout if you want to follow along. On January 1st, Matrix Inc. purchased land and building for $200,000 cash. Remember the cost principle. If we paid $200,000, that's how much we're going to record it in our books for. However, the appraised values are $162,000 for the building and $87,500 for the land. If you add that up, we got a very good deal. The appraised values came out at $250,000. So how do we record, according to the cost principle, $200,000? Well, we're going to go ahead and use those appraised values to figure out what percentage we can allocate that $200,000 to the building and what percentage we can allocate it to the land. So here you can see I just listed out the appraised values, and then I'm going to go ahead and use some math. I'm going to take $162,000, this is the building appraisal, divided by the total appraisal, and I get 65% of the appraised value is related to the building. I'm going to do the same thing for the land. $87,500 divided by the total appraisal to get 35% is going to be allocated to land. So there's my percentages. And then I'm going to multiply these percentages times the purchase price. So 65,000 times 200 and 35% times 200,000. Okay, then I can use this allocation to record my journal entry. So again, just using the appraised values, get percentage of total appraised values, multiply those percentages by the purchase price to figure out how do I allocate my purchase price to my assets. So here we record the building at 130,000, land at 70,000, and my credit goes to cash, or if I sign a note, it would be note payable, 200,000. So while the appraisal was at 250, I have to record my asset purchase at the actual price paid, 200,000. All right, the next thing we're going to talk about is depreciating. So important factors in depreciating include the cost, salvage value, and useful life. The cost of the asset is straightforward. It's the cost, again, of purchasing your asset, getting it to you, and getting it ready for use. The second piece is called salvage value. And I like to think of this as garage sale value, or maybe today it would be Craigslist or eBay value, right? So at the end of my useful life, when I'm done using this laptop, I'm going to determine how much can I resell it for. Okay, maybe I look on Craigslist and used laptops are going for $200. Okay, so that's my salvage value. And then finally, the useful life is going to be how many years do I expect to use it for business. Okay, how many years am I expecting to use this? If we're talking about a laptop for school, let's just say 4 years. At the end of 4 years, I'm going to use, I'm going to treat myself to a new laptop. Okay, now you might be wondering, where are these numbers coming from? No, I don't have a crystal ball. I don't know the future, but I'm using my best guesstimates to figure this out. I know my cost, that's a given, but my salvage value, I really don't know how much it's going to sell for at the end of 4 years, and I really don't know if I'm going to use it for just 4, or if it breaks down at 2 years, or if I decide to use it for, 6 years. Another word about useful life is that useful life doesn't mean that's the end of the asset's life. It doesn't mean it breaks at the end of 4 years. Okay, that's the number of years we will use it. Okay, the laptop may last for 10 years, but at the end of 4 years, we're going to resell it for $200 and let someone else use it. We're going to talk about 3 depreciation methods: straight line, units of production, and declining balance. Let's start with straight line. Straight line is relatively easy. You take the cost minus the salvage and divide that over the useful life. That results in your depreciation expense every single year that you own the asset. Okay, so if we're talking about our laptop, it's cost $2,000 minus the salvage $200 divided by 4 years. So $1,800 over 4 years gives us $450 per year. That would be, the $450 goes into debt. Depreciation expense would be debited for $450. Accumulated depreciation would be credited for $450 for 4 years. Okay, on your workout problem, we've got Ramirez Company, which installs a computerized manufacturing machine in its factory at the beginning of the year with a cost of $4,500. The machine's useful life is estimated at 5 years or 45,000 units of product with a $500 salvage value. During the second year, the machine produces 3,000 units of product. Determine the machine's second year depreciation under, and we're going to work on A, straight line. So you can see that there's a lot of information given to you, and you need to pick out the pieces that you need to compute straight line depreciation. So remember that straight line depreciation is cost minus salvage over useful life. So what is the cost here? We're looking at $4,500, a useful life of 5 years, and salvage value of $500. Now we can plug this into our formula and get $4,500 minus $500 over 5 years, depreciation expense of $800 per year. If we wanted to see what that looked like in a journal entry, it would be a depreciation expense would be our debit for $800, accumulated depreciation would be a credit for $800. This identical journal entry would be the same for every 5 years. Okay, so the second year, watch your questions carefully, the second year would be $800. Straight line is consistent. Each year is exactly the same amount. The next method we're going to look at is units of production. Units of production is 2 steps. We take our cost minus salvage, which is the same numerator as straight line, but we're going to divide that over our total output. That is going to give us our rate. That's step one. Step two is we take that rate and multiply it by the actual usage in each year. That gives us our depreciation expense. This type of method is used a lot in manufacturing. It can be used in offices. For example, a copier. We would take the cost minus the salvage over the total output that we expect to get out of the copier. Let's say it's 5 million copies. That would give us our rate. Then each year we would take our rate and then we would track the, I think it might be called an odometer, the little tracking system on the copier that tells us how many copies we use that year. So we would take the rate times, I don't know, let's say we copied 1,200,000 copies in the first year. So you take the rate times the actual usage to get your depreciation. So when we're talking about our laptop, now this is not very realistic. This units of production is not very realistic to use with a laptop. But you can see we have our cost and our salvage, and we don't really care about useful life. What we need is total output. So if I think about a laptop that I'm using for school, I don't know, I'm thinking term papers. Okay, so let's say we expect to get 100 term papers out of this computer. No, I don't have a crystal ball. I basically did some simple math and said how many classes would I take, and I don't know, an average of, I don't know, 2 term papers per class, or I think it was more like 2.5 or 3 term papers per class. Okay, so that's going to give us our rate. We can take 2,000 minus 200, our cost minus our salvage. Again, you don't care about the life, now you care about total output. So 100 term papers. That means that we've got a rate of $18 per term paper. Okay, that's step one. We can do that right away. But step two, we'd have to wait till the end of year one. At the end of the year one, let's say that we did 28 term papers. Okay, now we take our rate times 28 term papers to get a total depreciation amount of $504. Now next year, we may have a different number. We may have 10 term papers. We would take 10 times 18 and it would be 180. So depreciation expense is different each year because it's based on usage. Now often students want to know, well, what happens if we produce more than 100 term papers? Or what happens if we produce less than 100 term papers? You can modify your rate. Okay, you can also just determine to stop at the 100th term paper. Depending on if the 100th term paper got you close to your end of your life, you could just go ahead and stop at 100. You could also make an adjustment. We're not going to learn adjustments for units of production, but we will learn adjustments for straight line in just a moment. Okay, and again, our depreciation entry would be dead. Depreciation expense 504 and accumulated depreciation for 504. Okay, let's look at Ramirez Company. This is letter 1B on your handout. So we already read through the problem. Now what we want is cost minus salvage over total output. So what are the factors we need? 4,500 minus 500 over the total units. And I like to tell students, look for the big number, because for some reason they get overwhelmed, especially on exams, and they forget. What do I do? What do I do? Units of production, 2 steps. First step, you use the biggest number. Second step, you use actual usage. Okay, so this gives us, I rounded here, but about 9 cents per unit. Okay, the second step is to take actual usage. So our actual usage was 3,000 units. So multiply that by our rate to get $270. Our journal entry then would be for $270. And again, year 3 may change, or we would expect year 3 to change. It's based on usage, so every year is going to be different. Okay, the final depreciation method we're going to learn is declining balance. Declining balance is also 2-step. Step 1 is to figure out 1 over the useful life and multiply that times 2 to get our rate. Then we take book value times the rate to get depreciation expense. Now book value, remember, is cost minus accumulated depreciation. Okay, so every year we need to figure out our new book value and multiply it by our rate. So let's go back to our computer example. Remember, we said 4 years. So to get our rate, we could take 1 over 4 times 2, we'd have a rate of 50%. Now we need to figure out book value. Now book value is cost minus accumulated depreciation. how much accumulated depreciation do we have when we first buy the computer? None, right? So cost is going to be our book value. So $5,000 times 50% means we have depreciation of $2,500. I think I just changed the cost on us, so I apologize for that. I think we were using $2,000 before, but let's just roll with $5,000. So $5,000 laptop times 50% gives us depreciation expense of $2,500. Okay, that's year one. Now year two, we have to find the new book value. So we take cost minus accumulated depreciation. Well, how much depreciation have we accumulated? As of year one, $2,500. So cost minus accumulated depreciation gives us year two book value times 50% equals our new depreciation. Okay, in year three, we can keep that running book value by just subtracting depreciation expense from the prior year. So you can see this is just a pattern. So year three, we start with book value of $1,250 times our rate of 50% equals our new depreciation expense. Okay, couple of things to note. Again, you're starting with book value, which is in year one is going to equal cost. Now this is the one method that we don't worry about salvage value. Okay, we would adjust for salvage value in the last year. Okay, because we would not want to bring our book value down to less than our salvage value. But basically, initially, you ignore the salvage value. You worry about cost, and you worry about the number of years. Okay? And you can see that this depreciation amount declines over the years, which is why it's called declining balance. $2,500 in the first year, $1,250 in the second, $625. So oftentimes companies will use this because it basically it mimics what really is happening, right? If you buy a brand new piece of equipment, it's going to be the best piece of equipment in year one that you own. You're going to use it a lot. You're going to really get good use out of it. Year two, you're going to have a little downtime for repairs and maintenance. You know, it might not be working as good as when it was first brand new. And by year three, again, a lot more downtime, plus perhaps at this point you're buying a new machine that you're running most of the production on the new machine, and now this machine has now become your old machine that you're not using as much. Okay, so declining balance. Okay, here's your journal entry. Depreciation expense, this would be for year one, would be $2,500, and accumulated depreciation. Now this is on your handout, Ramirez Company 1C. Okay, remember the first thing we want to do is get our rate. Okay, so 1 over 5 is times 2 is 40%. And then we want to find our book value. Book value, year one, is just going to be the cost. So 4,500 times 40% equals $1,800. Okay, that's year one. But remember the question is asking for second year. So how do we get book value in year two? We're going to take cost minus the accumulated depreciation, which at this point we've only accumulated depreciation of $1,800. So cost minus accumulated depreciation is going to give us $2,700 book value times 40% means that depreciation expense in year two will be $1,080. Okay, and we can record that in our journal entry. Dead. Depreciation expense $1,080, accumulated depreciation $1,080. Now, it's important to note that these three depreciation methods, all of them are acceptable. Straight line is the easiest and therefore the most widely used. Okay, but straight line is very consistent year over year. Units of production varies depending on usage. In year three, we barely used it, if at all, so there was no depreciation expense. And finally, declining balance. The depreciation expense declines over the years. Now it's really important to note that all three methods depreciate the exact same amount over time. You're always going to depreciate cost less your salvage. Okay? Now a couple of notes. What happens when you buy it mid-year and what happens when you change things? So we're just going to talk about these two scenarios with straight line. So let's start with partial year. If you buy something at a partial year, how do you adjust for that? So here, this is on your workout. Ramirez Company installs a computerized manufacturing machine on June 30th, so mid-year, with a cost of $4,500. The machine's useful life is 5 years with a $500 salvage value. So this is the same information as we used before. But because it's mid-year, we're going to multiply it by the number of months that we own it over 12. Okay? So since we bought it on June 30th, if you buy it at the end of the month, that month doesn't count. So then we start with July, and I'm using my fingers right here. So July, August, September, October, November, December. I own the asset 6 months. So we're going to take that first year depreciation and multiply it by 6 over 12. If we bought it on June 1st, and this always tricks students, so if we bought it on June 1st or June 2nd, beginning of the year, then we would include June because we would have owned it all of June. So then we would start with June, July, August, September, October, November, December. So we would depreciate it for 7 out of 12 months. Okay, so just a note, watch your dates, and it's not bad to count with your hands. I do it every time with these types of problems because I really need to think through, did I own the asset for the whole month or not the whole month, so I don't depreciate that month? And do I include it or do I exclude it? So here, our straight line depreciation was $4,500 cost minus $500 salvage over 5 years. But in year 1, we have to adjust for the partial year. So in year 1, I'm going to take that $800 times 6 months over 12 to get $400 of depreciation the first year. Year 2, we will go back to $800 per year. Okay, but the year 1, we're going to adjust for it. The second issue is what happens when we change our estimates. When we change our estimates, and again, we're only talking about straight line, when we change our estimates, we're going to go ahead and basically create a new entry that's book value minus salvage over the remaining number of years. And that's key there, the remaining number of years. So we don't go backwards and adjust for what happened in the past, but starting in the year that we make the change, we adjust our depreciation going forward. So this is Ramirez Company, this is your handout. They chose a straight line depreciation method, but realized early in the second year that due to an increased demand of production, the equipment will last only a total of 3 years. The salvage value remains unchanged. Okay, so first we got to figure out, what did we depreciate in year 1? We depreciated $800. Okay, early in the second year, so we're able to catch it for the second year. So in the second year, we need to redo this. So we need to figure out what's the book value in year 2. Remember that book value is cost minus accumulated depreciation. So $4,500 minus, we only depreciated 1 year. So $4,500 minus $800 minus the salvage, which didn't change, over the number of remaining years. So our equipment, our new estimate was 3 years, but 1 year already passed. Okay, so now we're going to take 2 years. And that's key. You need to understand how this works. It's going to last a total of 3 years, but 1 year already passed. Okay, so going forward, year 2 and year 3, we're going to depreciate $1,600 per year. All right, now we're going to talk about disposal. So the end of the asset life, we can dispose it. And here's just kind of a quick key, but I'm going to walk you through this. So this is again another handout problem. Loan company has a machine with a cost of $10,000, accumulated depreciation of $8,000. Remember that accumulated depreciation is a contra asset. It is married to the asset account. So they go together. If we sell the asset, both of them go. Okay, so that's key. Asset, the fixed asset and accumulated depreciation are together. They're married. If we get rid of one, we get rid of the other. So let's prepare the journal entry if an A loan sells the machine for $2,000. Okay, so first thing first, record what you know. We know we're selling an asset for $2,000. Okay, so there we have cash, $2,000. Now we need to get rid of the equipment. So let's credit the equipment account for the cost. The equipment's on our books at $10,000, the cost that we bought it for. Okay, if we get rid of equipment, or in this case machinery, if we get rid of that machinery and equipment account, we have to get rid of accumulated depreciation. Okay, in this case, our journal entry balances. Why is that? Well, we can figure out cash received minus the book value will give us our gain or loss. In this case, cost minus accumulated depreciation was $2,000. Oops. I thought I had that written out. So $2,000 is our book value, so cash was $2,000 minus book value of $2,000 equals 0 gain or loss. Okay, and B, if we sell the equipment for $5,000, first write down cash of $5,000. We know we got $5,000 of cash. Get rid of the equipment at the cost of $10,000. Get rid of accumulated depreciation because they go together, right? So now we have a book value of $2,000 and we're getting cash of $5,000. We have a gain here. Okay? Gains are kind of like extra revenue, and revenues are always recorded to the right. Okay, we could, if you were confused about whether or not to debit or credit the gain, you could also just add up. We've got $13,000 in debits, we need $13,000 in credits. Okay, but a gain is kind of like an added revenue. Revenues are to the right. All right, and finally in C, if we only sell the asset for $500, okay, that should say C just to not confuse you. Get rid of the machinery with a credit. Get rid of accumulated depreciation because the two of them go hand in hand. And now what do we have? We only got $500 and we have a book value of $2,000. That means we have a loss of $1,500. Losses are like added expenses. Expenses are always debited. Okay, or again, you could just add up $8,500 debit, $10,000 credit. Oh, I know I need a debit, so losses are my debit. Depreciation, remember, appears on your balance sheet. You've got property, plant, and equipment, all your different asset accounts, less your accumulated depreciation. That's a negative number. So all of our assets less accumulated depreciation equals our net book value. Okay. Now this is helpful to a user of a financial statement because it can kind of give you a gauge of how new or how old the assets are. In this case, we have $575,000 worth of assets and we've depreciated $122,000. So overall, our assets look like they're on the newer side. If we had $575,000 of assets and we had $500,000 in accumulated depreciation, then this company has not been keeping up with replacement plan. Our assets are a little bit on the older side. If we were going to invest in this company, we would want to be wary of that. Okay, couple more things in this chapter. We're going to look at ordinary repairs versus extraordinary repairs and betterments. Ordinary repairs are just normal expenditures. They're things like oil changes, regular maintenance. They do not extend the life. They do not increase productivity. We record these as normal expenses. They're revenue expenditures, meaning they're matched with the revenue. They're regular expenses. Betterments basically are capital expenditures. They go to the asset. So if we have a betterment, we would increase the value of the asset. It's a major overhaul that basically increases productivity. Okay, and extraordinary repairs extends the life. Okay, so things like this might be if we change out an engine in a car. That's going to increase the life, right? So that would be an extraordinary repair. All you need to know is these definitions, and you need to understand what types of expenses would be classified. So here's from your handout. Oki Company pays $26,000 for equipment expected to last 4 years and have a $2,000 salvage value. Prepare your journal entries to record the cost related to this equipment. During the second year of the equipment's life, $2,000 cash is paid for a new component expected to increase the equipment's productivity. That's a betterment, and you add it to the asset value. So your debit would be to equipment, your credit would be to cash. Okay, B, during the third year, $500 cash is paid for normal repairs. Normal repairs are a revenue expenditure. You would record repair and maintenance expense as a debit. Cash would be your credit. And C, during the fourth year, $1,000 is paid for repairs expected to increase the useful life of the equipment from 4 to 5 years. That's an extraordinary repair. We would debit the asset and we would credit cash. Okay, here's just a problem that I pulled that's similar to your homework. It's just a little bit more complex, so I wanted to run through it with you. On January 5th, Walker purchases a used machine for $15,000, readies it for use the next day at a cost of $3,000. On January 4th, it is mounted on a required operating platform at a cost of $500 and is further readied for operations. Management estimates the machine will be used for 8 years and have a $2,500 salvage value. Depreciation is straight line. On December 31st of its 6th year, the machine is disposed. Okay, A, prepare the journal entry to record depreciation at the year of the purchase. Okay, we're going to go ahead and do it below. So first, how much did this machine cost? We're going to add all the costs it took to get it ready or purchase it and get it ready for use. So $18,500. We're going to take that minus the salvage value and divide it by 8 years to get $2,000 depreciation expense every year. So plug that into depreciation expense and accumulated depreciation dead. The second question asks, what is the total accumulated depreciation at December 31st on the 6th year? So accumulated depreciation, remember, is all the depreciation accumulated over time. So if we put $2,000 in this pot every year for 6 years, it's $2,000 a year times 6, or $12,000. Okay, finally, let's do C. Prepare the journal entry to record the machine's disposal under each of the following separate assumptions. If it's sold for $2,000 cash. Okay, so record the cash. Take the asset off the books at the purchase price, so $18,500. Take accumulated depreciation with it at $12,000. And then finally, you want to figure out your loss. And again, you can take your loss cash minus the book value of, what is that, $6,500 equals a $4,500 loss. Losses are like expenses, they're debited. Okay, and under the last scenario, if it's sold for $10,000 cash, same thing, record the cash as a debit, take the machinery off the books, take accumulated depreciation with it. Here we would have a gain. How do we get that gain? Cash paid minus the $6,500 book value equals a $3,500 gain. Okay, 2 more topics in this chapter. I told you it's a long one, so hang in there with me. Intangibles. Basically, intangibles are items that have value in the company, but you can't really see them. They're things like trademarks, patents, those types of things. The book goes into definitions and years and all sorts of detail on each type of intangible. I don't want you to worry about those. What I want you to worry about is how, big picture here, and how do you record this amortization expense. It's the same computation as straight line. So cost over salvage, or cost minus salvage over the useful life. That's going to give you a straight line amortization every year. And it's recorded just the same as dead, but you replace depreciation with the word amortization. So amortization expense and accumulated amortization. Goodwill is an intangible asset. However, it's the only intangible asset that is not amortized. It only occurs if you buy an existing company, so you can't create your own goodwill. Basically, when you buy a company, you take the fair market value of all the assets purchased minus the purchase price of the company, and what you overpaid is goodwill. Basically, you're paying for reputation, you're paying for all the existing customers. That's what you're paying for in good terms of goodwill. Okay, so 2 important things to note. You can only get it if you buy an existing company. You can't just add your own reputation on your books. And it's not amortized. What happens is at the end of every year, you look for an impairment. You look and see, did I harm my reputation? If so, we record it down. If not, you just leave it on the books as it is. Okay, finally, depletion. This is for natural resources. When we mine quarries or mines, this is depletion. It's natural resources. You're using the ground if you mine gold, those types of things. So it's the same computation as units of production. Step 1, you take cost minus the salvage because, it's natural resources, so you're using the ground. If you own property, or if you buy property, oftentimes you can go ahead and sell that property. We had an example nearby us where they had like a quarry pit, and at the end they sold it back to the city and they made it a park with a really beautiful lake. Okay, so cost of the land, or whatever it is, minus the salvage value over the total output gives you the rate. Step 2 is each year you look at the rate times the actual usage. Now once again, you're going to take the same dead entry, you're just replacing depreciation with depletion. So depletion expense, accumulated depletion. Depletion is for natural resources. Last example here, Quarantine Company acquires an ore mine at a cost of $1.4 million with an estimated 1 million tons of ore. The estimated value of the land after the ore is removed is $200,000. What's the entry to record the cost of the mine? It's an asset, recorded on the books, and put notes payable or cash as your credit. Okay, B, we need to figure out first what is the actual rate. So 1.4 million minus 200,000 over 1 million is that total tons. Gives you 1.2. And then we have to figure out if we mine 180 tons, you take 180 times your rate of 1.2, which would give you 216,000 for that specific year. Depletion expense 216, accumulated depletion 216,000. All right, whew, we made it. If you have questions, make sure you contact your instructor or seek help in the tutoring center. Again, I would just recommend you spend a lot of time on Chapter 8 and pace yourself and maybe break down the chapter over several days in terms of studying through it, because this chapter isn't difficult, it's just got a lot of pieces to it. So work on your note cards, quiz yourself, maybe break it down, one day learn the depreciation methods, the 3 different methods, maybe the second day put those into practice, maybe then do sales one day or disposals one day. You could do basket purchases one day and then do one day for intangibles and natural resources. All right, have a great day. Thanks for joining me.